The name of our company is Infinity Investments. We're a commercial real estate brokerage and investment firm. We're based here in Oakland. We started in Jack London Square. We just moved to this location in August. As of August, we'll actually haven't had our grand opening. We'll have a grand opening next month. But this is our location. We were able to purchase this property along with the 2 condos next door. So hopefully this will be our home indefinitely. And we thank all of you guys for coming out this evening. What I'm going to do tonight is I'm going to kind of go into our presentation about multifamily investing, talking about some of the basics, some of the fundamentals. So why is that? There's a couple different factors that I believe that make multifamily the top choice for investors. The first thing is stable cash flow during the holding period. So here's what I mean by that. Stable cash flow in the sense of you're going to have relatively high occupancy levels when you look at other food groups, other product types. When you look at a single family home, when you have that leased out, you're 100% occupied. Now, when that tenant moves out and relocates, for that time until you find another tenant, you're 100% vacant. So, when you average it out over a year, it's probably not that bad. But that month that you're 100% vacant, you gotta be prepared for that because your mortgage is not 100%. Your mortgage is still there. Your mortgage is not 100% vacant. It's still there. That's why when you're looking at hold properties, sometimes multi-units a little bit better than single family. Single family, when you're flipping, it's money, it's gold all day long. And really, truthfully, when you get a great tenant as a rental, it is as well. But it's not so stable when they move out and it takes you a month, 2 months to find somebody because it's a whole month of rental income that you lose out. When you're dealing with apartment buildings, if you got multiple units and somebody moves out, which they will, then you've got the other units helping you out. You're not going to have the same cash flow you had previous to that, for the previous month when that person was in there, before there was that turnover, but you have the other units helping you out to generate enough income to cover the operating costs, to cover the debt service, the mortgage payment, and hopefully still have some cash in your pocket. That's what I talk about. That's what I mean when I talk about stable cash flow during the holding period. And that ties into high occupancy rates historically and currently. Let me just say this, right now the rental market is outstanding. Pretty much everywhere in the Bay Area, even the Central Valley is beginning to recover. However, in 2008, tail end of 2008, 2009, the rental market was not doing very well. It was doing really bad, in fact. But even at its worst point, vacancy rates here in Oakland never truly got above 10, 11%. Okay, that still means that 90% of your units you're going to have occupied in the worst part of the market. Now, I will say this: in Stockton and Sacramento, that wasn't the case. Their vacancy rate got up to about 20%. Even though you still got 80% of the rental income to deal with, okay? When you're talking about office, you're talking about retail, industrial, we saw vacancy rates go to about 40%. Okay, that's a big risk, and it was just a tough time. Single family homes were sitting on the market for rent because in 09, 08, there was such a glut of property on the market that it was, you had high vacancy rates. But even at those times in apartment buildings here in Oakland, the worst vacancy we had was about 10, 11%. Stockton, Sacramento, about 20% in the worst times. So that's what I talk about, high occupancy rates historically. Financing, we were just having that conversation about financing. Now, it's not as attractive as obviously a single family home with 1 to 4 units. But when you look at apartment buildings as it relates to office, retail, industrial, hospitality, apartments rank at the top of what lenders want to give you money for. And it ranks at the bottom of what the interest rate, the cost of the money is going to be. So that's why we like apartment buildings. You asked about non-recourse. Apartment buildings are just about the only type of property, commercial property, that a lender will give you a loan for and not require a personal guarantee. Most of them will, but you can find loans through some of the agencies, FHA, Fannie Mae, Freddie Mac, that they'll lend to you and you won't be personally on the hook for it. You still got to qualify, but they're not going to come after you if you lose a place. And that's important to investors. You don't never want to leverage your whole or put your whole portfolio at risk for one property. That's kind of a rule of thumb for disciplined investors. Economies of scale that SFRs and some other units, other product types don't have. When you have 10, 20 units, when you get a rent growth, now that's across the board on 10, 20 units, not just one unit. So you got the multiplier effect versus the addition effect. So synergy. So you got rent growth on 20 units at $10 a pop. Now, your rental growth is gonna, is gonna grow more than 10%. So just saying that all to say is you get economies of scale. The flip side of that is when you get hit with expenses, you have to be prepared to deal with that. And when you have multiple units, you just have an ability to be able to cover more than you do when you don't have it. So the last thing I'll talk about is it's an excellent preserver and generator of wealth. You got a lot of money and you want a low cap rate building. I'll talk about what a cap rate is. If you want something to preserve your money, apartments is a good place to go. If you don't have a lot of money and you want to create wealth, apartments are a great place to create it. And a big part of it is that when the market dropped from a price standpoint, prices dropped about 50%, 60% in some areas. The rents never really dropped that low. Rents and vacancy rates came up. Rents came down a little bit at the worst part, but it didn't drop 50%, 60%. So now it's an opportune time for investors to come buy properties at a low price point, and especially right now, where now the rents have really recovered and we're having a strong growth period of rents right now. So it's it's a perfect storm for apartment building investments right now. So when we've identified the fact that this is the asset class, this is the product that we want to go and acquire, it then becomes a matter of what do we look at? What are some of the indicators that are going to help us make a good decision on what investment to make? Well, here's the top thing that we kind of look at. There's more than this, but we want to start with something, like I said, the fundamentals. That's what tonight's about. The cash flow. Jason Matthews talked about your financial planning and the importance of having cash flow and setting up cash flow for the future, because there's things that are going to be eating at your wealth. So when you're looking at investments, multifamily, you got to look at the cash flow. What does that mean? You got to look at the NOI details. That's the net operating income. NOI is net operating income. The details around that. The price as it relates to the cap rate. I'll go into what cap rate is. Very, very important is the rent roll. Rent roll tells you who your tenants are, how much they pay, when they moved in, when they move out, all of that. That's critical. When the lender is going to ask you for your loan package, you're going to have to give them all your personal stuff, and you're going to have to give them the rent roll from the property, the profit and loss statement, all the expenses from the property. But it really starts with that rent roll, because that's going to be your income that you can count on once you close on the asset. Then this measure is very, very critical. Cash on cash return. This is the measure that evaluates your dollar into the investment. In other words, this measures how much money your down payment plus closing costs earns you on an annual basis, and it's calculated in a percentage. So I'll go into each one of these and how we calculate them and such, but these are kind of the blocking and tackling of apartments. All right, so what I'm going to do is just kind of walk down in the next few slides when we're analyzing the property. How do we break it down? If you've been in the business, this may seem very elementary, very fundamental, and it is. And these are the things that we want to do every single time that we're looking at a deal, whether it's 4 doors or it's 100 doors. The same principle applies. We got to look at we got to analyze the income, what the now income is and what the future income is. Because the now income is important. It's tell us where the asset has been, but the future income is just important. It's going to tell us where the asset's going to be. And we have to come up with an educated guess about what that's going to be. We can't just shoot from the hip. We have to take what happened in the past and put together a realistic projection of what's going to happen in the future, so we can know what this is going to yield us. So when we're looking at a building, we'll look at first the income. Now, in apartment buildings, let's just go down the line. Our income comes from rents, right? So we start with our gross scheduled rents. This is the amount of rent, and this is also referred to as potential rental income, gross potential income. For our purposes, we call it the gross scheduled rents. This is on your rent roll. This is the income that you would receive if 100% of the units were rented out and then 100% of the units were paying. Because remember, not all tenants pay when they're supposed to. That'd be nice if they all did, but they don't. But if they did, every single unit was leased out, everybody paid their money, that's your gross scheduled rent. Then take away from that the vacancy factor. When you are evaluating a building, you'll be able to look at the actual numbers and find out what that vacancy percentage is based on what the rent roll says and what the actual numbers were. So then you come up, that's how you take away, you come up with the vacancy factor. You can also look up on places, you go to marcusandmillichap.com, hendricksandpartners.com, and print out market surveys. They do a quarterly market survey for each major market. If you're somewhere out in the boondocks, you might not be able to get that information, but if you're in pretty much any one of the major MSAs in the United States, you'll be able to go to hendricksandpartners.com, marcusandmillichap.com, and you can get average vacancy rates for each metro area, and then each was called submarket. So a metro area may be the Oakland East Bay, a submarket may be downtown Oakland, maybe Lake Merritt, maybe Emeryville, that's a submarket. So you can get that information online, but you want to look at what's actual as well. Then this is important, take away what's called the loss to lease concessions. That's when people don't pay you. That's going to happen sometimes. Also, if you're in a tough rental market, you might need to do some first month free, you might need to do some move-in specials in order to entice tenants to come in. Right now, not a lot of that's happening because the market is strong, but there's something to be aware of at the time of acquisition. So you minus those numbers. Then what you're going to do is you're going to add what's called other income. Real simple enough. Real simple. Other income is other income other than rental income. This could be from a billboard. You have a property like right next door, they got a billboard, and you walk out and you see that building owner's getting paid for that. Also, it could be vending. What's most popular is laundry. Laundry is important to have in apartment buildings because most apartment units are not going to have laundry machines, therefore your tenants will have to wash laundry somewhere else. If you have laundry on your building, they're going to use it 9 times out of 10. That means other income for you. You add that to the gross scheduled rents, gross scheduled rents minus vacancy, minus loss to lease, add to that other income, that gets you your effective gross income. That's the real money you collect. Now, when we're running numbers, we always run them annually for the year, but you also want to divide that number by 12 so you know what your monthly number looks like. But we're looking at this annually. That effective gross income is the money that you actually bring in. Rental income plus your other income. All right?